Hi, my name's Tom Harden. I'm Chief Investment Officer of Canterbury Investment Management. Today's date is June the 9th, 2020. We're doing this video to give an overview of what's been happening in the markets over the last 3 months or so, and also give some insight into some of the actions that we've taken in the portfolio. Now, as you know, the recent events have created a lot of challenges in a lot of ways. As far as the markets are concerned, we've really kind of received a crash course in why human logic is not equipped to understand or to predict how unexpected events are going to impact the markets. We've certainly seen more than our share of unexpected events, as well as seeing some very strange market behavior. The March 9th sell-off was particularly hard to deal with. It started from a new market high and very low volatility. These are characteristics of a low-risk environment. A sharp decline like what we saw will typically be preceded by a period of steadily increasing volatility. Increasing volatility gives a warning that something bad could be on the horizon. And that certainly was not the case at the peak on February the 19th. Now, during the rest of February, the S&P 500 began an expected and somewhat normal correction, had a couple outlier days. Then, on March the 6th, a normal correction changed to something that was entirely different. On that day, the S&P 500 dropped 7.2%. The S&P 500 hadn't dropped 7% since the worst period of the 2008 financial crisis. The market was then down about 20%, and that happened over about 13 days. At that time, our portfolios were down about 13 to 14%. Now, to give you a point of reference, on March the 6th, that was the day that the first school closings occurred in California. Now, other than for the flight restrictions from China, all businesses were still up and running, and there had been no other closures or stay-at-home orders up to that point. Now, regardless, our adaptive process has specific rules and strategies to deal with the unexpected. There are realistically two primary courses of action that could be taken following a decline like we saw in March. The first one would be to take immediate defensive action, meaning sell off some or all of the stock-related holdings and buy bonds or maybe some inverse exchange-traded funds. Inverse funds go the opposite direction of the market. Or they'll go up when the market goes down, or vice versa. The portfolio would then remain stable whether the markets went up or down. Second option would be to keep the existing holdings, maybe make a few upgrades in the portfolio, and then wait for a rebound rally, and we would then add the alternative asset classes, bonds, and inverse funds to stabilize the portfolio, hopefully then at higher prices, higher levels. The risk of the first option is that the market could go back up very quickly after taking the defensive action. Selling into a sharp decline is generally not a good idea because equally sharp rallies in the opposite direction are they're very high probability. Selling after a substantial decline will tend to lock in the losses. On the other hand, holding the existing portfolio would mean that the value would continue to fluctuate either up or down along with the markets. Now, adaptive portfolio management rules would choose the second option during an extremely rare event like the March sell-off, meaning that we would continue to hold the existing positions. Now, as a quick review, market fluctuations are driven by supply and demand. Supply and demand are in turn driven by the buying and selling actions of investors. Now, our studies show that during highly volatile periods, human intuition tends to cause investors to exaggerate their actions both ways. They tend to sell near the bottom and then buy somewhere near the peak. As a result, markets will tend to overcompensate and they tend to move too far in both directions. Brandon and I did a video on March the 23rd at the bottom of the market. He said that the upcoming rally would be strong and it would happen fast, over a few days, not a few weeks. If you weren't already in, there really wouldn't be time to get in. The rally started the very next day. Now, that said, we were still all surprised that the S&P 500 regained half of its 34% drop in only 13 days. Our portfolio regained over 40% of its initial decline. We then took the actions we talked about and stabilized the portfolio, mainly through buying inverse exchange traded funds. Over the next 20 trading days, most equity markets in our portfolio remained in a narrow trading range. The S&P 500 and other stock indexes finally broke above the ranges on May the 26th and went higher from there. The Canterbury portfolio remained stable and did not participate in that following advance that occurred over 16 days. Brandon will give an overview of why we didn't participate, and then we're going to follow up with some reasons why we believe that the Canterbury portfolio will be entering into one of the best environments for adaptive portfolio management that we've seen in over 10 years.
As Tom said, we want to go over, some of the recent market movements as well as the recent rally that the thermostat was able to remain stable through. And the easiest way to do this would be to look at the following chart. As Tom mentioned, the market, or in this case the S&P 500, was in a low volatile environment at the market's peak on February the 19th. We then saw the beginning of a normal market correction up through March the 6th. And to avoid potentially getting whipsawed or stabilizing the portfolio right at a potential bottom or missing a rally back, the thermostat rode a wave of volatility in the market, waiting for a 50% recapture of the overall decline. This recapture happened very quickly, and the thermostat added inverse positions to its holdings to stabilize the portfolio, with the expectation being that the market was going to remain volatile and fluctuate in both directions. Then starting in mid to late April, the stock market actually entered a small trading range, fluctuating both up and down while the thermostat remained stable. Then on May the 26th, the market broke out of the range and rallied higher to the point it's at right now. And if we're looking at this, what really caused this kind of rally? This short, exaggerated rally in the market was led by stocks that had previously gotten slammed. In fact, if we look at a list of the top performers in the S&P 500, well, the S&P 500 was led by many airlines and cruise liners. Looking at a couple of the names, you'll notice, United Airlines, American Airlines, Royal Caribbean Cruise Line, Boeing, Carnival. These stocks rallied substantially, increasing anywhere from 50 to 100% in just about 3 weeks. On the flip side, these stocks are nowhere near putting in a new high. In fact, most of them are at least 50% away from doing so. Eager investors who may have missed out on the rally off the March lows feared missing any more potential gains and poured into these suppressed stocks. And as these investors began dashing for trash, indexes like the Russell 2000 and S&P mid caps, which were previously some of the worst indexes, experienced rallies. So, why did the thermostat remain stable? Well, the portfolio thermostat, holds positions in technology, consumer discretionary, and healthcare, just to name a few examples, which all went up actually over the last few weeks. But the market is still volatile. It's still very volatile. And as part of that stabilization process, the thermostat also held positions in inverse Russell 2000 and inverse S&P mid caps, which we just mentioned. In a dash for trash had also risen. So the thermostat actually, remained relatively flat over the past couple weeks.
Make no doubt about it, We are in a very high-risk market environment. We've been in a high-risk environment since March the 6th, the day that the S&P 500 dropped 7.2%. The S&P 500's peak was at 3683 on February the 19th, and it closed yesterday at 3232, down 5.6%.
And that all sounds pretty boring, over the last 4 months, doesn't it? But, the reality is that the S&P 500 traded as low as 2234, which was 34% off its peak, and then went back up 45% to yesterday's value. So the question is, which day is the real value? And if you're a long-term investor, none of this really matters because this is all what we call fake pricing. Unless you make a mistake and sold at the bottom or about to make a mistake and are ready to buy back in following the current 40% advance that happened over the last few weeks, well, in that case, you're probably going to dig yourself a hole that could take years to get back out of.
So, it's important to understand that you only make money when your portfolio reaches a new high. And, in fact, the markets have yet to hit a new high. And if they did, there's no reason to believe that they could hold that high to within 30 to 40% based on the current environment anyway.
Yeah, and the goal is to keep the time between new highs as short as possible and have reason to believe that you're actually going to be able to keep that new high and hold it within a reasonable level and that the portfolio has a chance to establish another new high within a reasonable amount of time.
Right.
And the portfolio thermostat has the capability to stabilize its volatility to normal fluctuations in any environment. And its volatility was stabilized after regaining about half of the total drop coming off of that March low. And it's remained stable since then. There's no way that our process could have sold all the securities that were used to stabilize the portfolio and in turn bought, stocks that have been suppressed like airlines or cruise liners or
real estate.
Exactly. Just to participate in a 3-week dead cat bounce that's continued, even though there's so many different events,
riots,
that defy logic kind of going on in the world.
So, our process was designed to actually benefit from volatility. The portfolio should remain stable as the markets go down. And, it should even adjust as markets become either oversold or overbought. The idea is to continue to have the portfolio come off of a bigger base each time. We call it the ratchet effect. So each time it goes down and pulls back, it should come off a bigger base as it grows and then actually benefits from volatility.
There's been a lot of activity in the markets over the past couple weeks, and they've kind of rallied defying logic. But if anyone believes that markets are just going to continue to go up from here with no meaningful corrections and that bear markets will be a thing of the past, then the portfolio thermostat's not going to be much of a benefit for you.
Well, our indicators are showing that the market environment has changed and that we're going to continue to see high volatility as well as meaningful declines into the future. That's the kind of environment that the portfolio thermostat was made to manage.
And so we hope this video has kept you informed on both the markets and the portfolio thermostat and kind of the strategy that we're going through here. And we look forward to talking with you soon.
Thank you.